When will the Fed stop raising rates? Not as soon as you think. Raising interest rates to deliberately slow the U.S. economy isn't a job for the faint of heart, but the next test for the Federal Reserve could make even that challenging task look simple. Officials will soon have to decide first when to slow the pace of interest rate hikes, and then when to halt those increases altogether. The higher borrowing costs climb, the more pressing it will be for U.S. central bankers to figure out. Interest rates in September officially crossed the crucial level of 2.5%, thought to be the neutral rate of interest, or the point at which borrowing costs are believed to be taking steam away from the financial system. Economists say the move marks the point when the job market and broader economy could start to bend underneath the weight of monetary policy, though, what really matters is when interest rates could start to break inflation. Pulling back on rate hikes too soon risks keeping inflation elevated, meaning any Fed pause could be short-lived. But doing too much could slow the economy more than necessary, harming Americans' job prospects and further squeezing people's buying power. But the Fed isn't ready to call it quits just yet. Most economists say the Fed will likely stop raising interest rates at some point in 2023, but where rates peak, a level known as the terminal rate, is more important than when. Fed officials are clearly divided over how much further above neutral they'll have to take interest rates. The highest estimates from the Fed call for an additional 1.75 percentage points worth of rate hikes from here. Those projections show the Fed's key federal funds rate peaking in a target range of 4.75 to 5% by the end of 2023, meaning the Fed would take rates to a 16-year high when it's all said and done. Yet, the median projection says the Fed's rate will top out at 4.5 to 4.75% in 2023, slightly lower but still the highest since 2007. Economists and Bankrate's third-quarter economic indicator poll also see rates peaking at that level. The Fed has said it wants to reach that peak level as quickly as possible in a so-called front-loading of interest rates. The idea is, the sooner you get interest rates to the point that might start to cure inflation, the less you risk overdoing it. With a median estimate, one hike in 2023 worth a traditional quarter of a point would be on the table. Yet, those projections came before consumer inflation didn't cool as much as expected in September, rising 8.2% from a year ago in the Department of Labor's Consumer Price Index (CPI) report. Prices on many items also moved in the opposite direction the Fed wants, up. They're also adding the most growth to year-over-year inflation since the early 1990s, according to Ryan Sweet, Senior Director of Economic Research at Moody's Analytics. One of the biggest lines in a household's budget is continued increases in shelter costs could offer Americans, and the Fed, little relief on the inflation front. Savers looking to maximize their earnings will want to pay close attention to the Fed's terminal rate. It might indicate when yields have hit their ceiling, though banks' offerings still depend on money-related supply and demand factors in addition to Fed moves. Banks have more than doubled their payouts since the start of the year, while individuals who park their cash at an online bank have seen even bigger earnings. Yields at those non-traditional institutions have been climbing by the week, with some even offering a 3% annual percentage yield, APY, as of October 24. Figuring out when the Fed will stop hiking rates is also important because of the debate that often follows: when to start cutting. The Fed is going to be looking for compelling evidence that inflation is moving back down to its 2% target before making it cheaper to borrow money, Powell added at the Fed's September post-meeting press conference. A forecast from investment bank Morgan Stanley shows the Fed cutting rates by 25 basis points in December 2023. Investors are also starting to predict rate cuts for later in the year, according to CME Group. But mortgage rates certainly don't have to wait for the Fed's word to start falling. Influencing the key home loan even more than the Fed is the 10-year Treasury yield. That key rate and then the 30-year fixed-rate mortgage could fall like dominoes if investors turn attention away from surging inflation and instead start to fret about a recession. A Bankrate survey of economists showed a 65% chance of a recession between now and the end of 2024. The Fed isn't shy about the consequences of higher rates.